Hey, it's John with Vision Advisors, and welcome to another Insight with Vision. In this particular episode, we want to talk about creating tax-favored income in retirement. My uncle was a CPA growing up, and he shared what he thought was conventional wisdom with me. And it's the same conventional wisdom that many financial professionals are still using today with their clients. They recommend that you maximize your 401k and your IRA contributions. They remind people that nothing outperforms the stock market over time. There's safety through diversification, and you've got to take a risk in order to make money. We hear financial professionals every day sharing conventional wisdom with their clients and their prospective clients. But guess what? Conventional wisdom can be wrong. If you were to sit down and have a conversation with your client and you were to ask them, what is the magic number that conventional wisdom says that you need to retire and be comfortable? The vast majority of your clients are going to give you a number like $1 million. So let's take an opportunity to look at what $1 million using conventional wisdom can do and the caveats of using conventional wisdom. And let's see what that looks like. So let me introduce you to Sean. Sean recently graduated college and he married his high school sweetheart. And using conventional wisdom that his Uncle Bill has shared with him, Sean wants to retire at 65 with $1 million in his 401k. So the question we want to ask is this: who really benefits from tax deferral? Whose $1 million plan is it really? So here are the assumptions we're going to use. Sean is going to contribute $6,000 a year for the next 40 years into his company 401k. He's going to earn an annual rate of return of 6% annually, and Sean is currently in a 30% combined federal and state tax bracket. Now, using these numbers, based upon current tax code, Sean is going to get an $1,800 deduction annually for the next 40 years. That's going to total $72,000. And at the end of 40 years, magically, Sean has his $1 million accumulated tax-free. All of the stars aligned, and Sean now has his $1 million. If Uncle Bill were still alive, he would be proud. But as Sean gets ready to retire, he remembers Uncle Bill saying, hey, if you've got a great rate of return, let's live off the interest. So $1 million earning 6% is $60,000 a year in annual interest. But Sean just found out, maybe he knew it, but he hadn't really thought about it. But now that he's taking money out of that 401k that's grown on a tax-deferred basis, all of a sudden Uncle Sam sticks his hand out and says, it's time for you to pay the piper. And Sean's got to pay taxes on that money. Well, over the 40 years that Sean's been alive, he's seen tax rates continue to rise. And now all of a sudden, Sean still finds himself in retirement in the same 30% combined federal and state tax bracket. So $60,000 a year at 30%, $18,000 a year Sean is paying in taxes. So he's netting $42,000 a year. That's not too bad until you do the math. And when you begin to do the math and think about what just happened, in 4 years after Sean retires, he's already paid taxes equal to the tax savings that he received over 40 years of saving. And if Sean lives to the ripe old age of 85, guess what? He's going to pay $360,000 in taxes. That's $18,000 a year for 20 years. So in reality, Sean saved $72,000 over 40 years of working in order to pay Uncle Sam $360,000 over 20 years of retirement. And then Sean dies. He's living off the interest, and now his heirs are going to inherit that $1 million of principal that, as it's distributed, all of that money is going to be taxable as well. So who really benefited from tax deferral? Sean and his high school sweetheart, or was it Uncle Sam? When we think about taxable versus tax deferred versus tax-free financial instruments your clients have access to, if they were to walk in the bank and open a CD, they wouldn't be able to deduct their deposit. Their money wouldn't grow on a tax-deferred basis, and they would pay taxes every year. So there would not be a significant tax burden if they were to withdraw that money at the end of that CD period. If, on the other hand, they were to use a tax-deferred instrument like an IRA or a 401k, they do get to deduct their deposit. The money's going to grow tax-free, but when they get ready to start taking money out in retirement, 100% of that money is going to be taxable. Now, if they're using a tax-free financial instrument, they're not going to get a deduction on the front end. They're going to be able to have tax deferral, but assuming they meet all of the appropriate parameters, that money's going to be income tax-free when it's withdrawn. Now, when you think about distributions in retirement for your client, they're only going to receive money one of two ways. That money is either going to be taxable or it's going to be tax-free in retirement. And if up to 85% of your client's Social Security can be taxed based upon the amount of taxable income that they're going to be receiving above and beyond Social Security, having tax-favored income in retirement makes good sense for most of the clients that you're working with. But when we think about tax-free income, many of us may think about municipal bonds. You've got to be securities licensed in order to offer those. And depending on the product offerings available in your state, and you have to buy products from another state, there may be state taxes that could be imposed. And earnings from a municipal bond do impact Social Security taxation. Others of you may be thinking about a Roth IRA. Now remember, a Roth IRA has limited contributions. There's a 5-year waiting period, and you've got to be at least 59 and a half before you can start taking money out without being penalized. We also think about Social Security as tax-free income as long as there's no other money available that causes that Social Security to be taxable. Social Security is one of only 3 guaranteed sources of income in retirement, the others being a pension or an annuity. But if you're making additional money in retirement, your clients are going to be paying taxes on their Social Security. Now, an area that's often overlooked when it comes to tax-free income is cash value life insurance. Universal life, index life, and whole life, in addition to an income tax-free death benefit, provide a cash value component that grows on a tax-deferred basis and over time can grow to a sizable amount if it's properly funded. Now, that money can be distributed through conventional means such as policy loans, either fixed rate or variable rate. The only downside of this strategy is if you take too much money out or the product underperforms or a combination of the two, your clients could be faced with a policy that lapses. And if the policy lapses and there are policy loans that are left unpaid, the IRS can come back and reclassify all of those distributions as income rather than loans. So one of the new features we're seeing today, and a handful of life insurance companies, and I expect more to follow, is a guaranteed lifetime income rider benefit that is available with a handful of carriers today. It's essentially a paycheck for life, but unlike an annuity, it's tax-free. We've seen income riders with annuity products for some time, but being able to have a life insurance policy with a guaranteed lifetime income rider is a new innovation, and it's another way to create tax-favored income that your clients will never outlive. And one of the neat things about these guaranteed lifetime income rider benefits, the way they're structured, the policy will never lapse. So your clients don't have to worry about taking out too much income or the product underperforming, because guarantees are there to prevent that policy from lapsing. Now, if you were to have a conversation with your clients and ask them to create the ideal tax-free solution, most of them would say they'd like to see unlimited contributions. At the same time, they'd like to see not only tax-deferred growth, they'd like to see tax-free distributions. They don't want to have to deal with required minimum distributions, and for some, they don't want to have to wait till 59 and a half to have access to the money without a penalty. Many of them like the idea of market-linked returns, but they also like the idea of having protection against market loss. They love the idea of a self-completion mechanism that if you die early, the plan completes and tax-free money is still distributed to your heirs. They love the idea that if they want to use IRA money to fund this ideal tax-free solution, there's a way to help pay the taxes on those IRA distributions. And lastly, they'd love to be able to pass whatever they don't spend during their lifetime to their heirs, income tax-free. Well, ladies and gentlemen, there are financial solutions that offer these benefits. And what are they? cash value life insurance policies, universal life, indexed UL, and whole life. So if your clients are looking for tax-free income in retirement, including guaranteed lifetime income, they're looking for a predictable rate of return, they're looking for principal protection from market loss, they're looking for a self-completion mechanism if they die early, and also the access to living benefits where they can go into and get access to those policy benefits if they get sick along the way, cash value life insurance is something your clients should be looking for. Now, for your clients, it's a choice that they've got to make. And there's a correct way to use life insurance. There's an incorrect way, just like there is any financial instrument that's out there. So you've got to help them choose, but choose wisely in the planning process. And that's where we come in. There's life at Vision Advisors. We understand the variety of different ways that you and your clients can plan to have a secure financial retirement. If they're looking for guaranteed income, there's a number of solutions that do that. If they're looking for tax-free income, there are different ways that we can make that happen. We'd welcome an opportunity to have a conversation with you about how you can show your clients how they can receive tax-favored income throughout retirement, no matter how long that lasts. Give us a call at Vision Advisors, 1-800-505-8489, and talk to one of our business consultants. We welcome an opportunity to help you help your clients see financial success. Hey, it's John Terry with Vision Advisors. Thanks again for joining us for this Insight with Vision.